Welcome to our fifth unit of investment management. And in this unit, we are going to be looking at the capital asset pricing model and the arbitrage pricing theory. In our previous unit, we were looking at risk and return. So we saw that there are different ways of calculating risks that are associated to an investment. We saw that an investor is faced with decisions whether he's going to make an investment in stock A or he will make an investment in stock B. We also looked at the portfolio investment, and we concluded to say that a portfolio is better compared to single stock investment. This is because a portfolio has the capacity of lowering the risk associated to individual stocks. So we saw that in as much as you are getting returns of a stock, that stock is associated with risk. For example, we looked at a firm that had the highest return. It was also associated with the highest risk compared to these other firms. And hence, we concluded to say that in as much as you are looking at the returns of a given stock, you also have to consider the risks that are associated to that stock. And we saw that the computation of how we can know about the risks that are associated with a given stock is using the standard deviation, which is simply the square root of the variance. The moment you square root the variance, you get the standard deviation, and that value that you're going to get is going to give you the risk that is associated with a given stock, because the standard deviation simply shows the dispersion of the value that you've gotten from the expectation that you wanted. That is what it shows. It shows the dispersion away from the mean. It shows the dispersion away from the desired. And we saw that firm B, which was the firm that was retaining the highest returns, it also gave us the highest standard deviation. It was retaining a return of 17.4, and it was associated with a standard deviation of 20%. You see? So at the end of the day, in as much as you are making investments, the decision in going for an investment lies upon you, the investor. Are you a risk lover or are you risk averse? You see? Do you love risk or you don't? Because higher returns are associated to higher risks. That is what we see. We also use the correlation of variation. The coefficient of variation. We also looked at the coefficient of variation, which was also explaining the risks that are associated to a given stock or a given investment. And in this unit, we are going to be looking at the capital asset pricing model and the arbitrage pricing theory. Capital market theory. Capital asset pricing model, CAPM, will allow you to determine the required rate of return for any risky asset. Capital asset pricing model, CAPM, is based on the observation that returns on financial assets increase with the risk. So we see that the assumption that is behind the capital asset pricing model is that when we observe the returns on financial assets, they increase with risk. The higher the returns, the higher the risk. That is what we observe. So the capital asset pricing model concerns with two types of risk, namely the asystematic and systematic risk. The central principle of the capital asset pricing model is that systematic risk as measured by the beta is the only factor affecting the level of return. So we see that the systematic risk, which is going to be measured by the beta, is the only factor that is affecting the level of return of the level of return on an asset. So we've seen that the capital asset pricing model is concerned, it's concerned with two types of risks: the unsystematic risk and the systematic risk. The central principle of the capital asset pricing model is that systematic risk as measured by beta is the only factor affecting the level of return. Capital asset pricing model, CAPM, is a theoretical description of the way in which the market prices investment assets. So this is just a theoretical description of the way in which the market prices investment assets. The way prices are given to investment assets. That is what the capital asset pricing model looks at. It is a theoretical description of the way in which the market prices investment assets. The capital asset pricing model is a positive theory. Unsystematic risk. Unsystematic risk can be diversified and is irrelevant. So we've seen that from the previous unit, we were looking at diversifiable risk and those risks which cannot be diversified. And we saw that if we can diversify stock into a portfolio, we see that we can lower the risk or eliminate the risk by adding more stock. Systematic risk cannot be diversified and is relevant. So we see that the main concern in our chapter here is systematic risk. And this systematic risk in the equation is going to be measured by beta. That is what we are going to look at. So we've got systematic risk and unsystematic risk. Unsystematic risk can be diversified and is irrelevant. Sorry. We've got unsystematic risk can be diversified and is irrelevant. Like we saw that diversifying is investing into different types of stock, and like just having one stock, which might not be a better thing to do because its standalone risk is going to be high compared to that of the portfolio. So diversifying the stock is a better option because you will be able to lower the risk that is associated. You'll be able to lower the standalone risk that is associated with different types of stock. Systematic risk cannot be diversified and is relevant. And in our case, systematic risk is going to be measured by the beta. Systematic and unsystematic risk. Specifically, total risk is equal to systematic risk plus unsystematic risk. Capital asset pricing model says unsystematic risk can be diversified away. It can be avoided by diversifying at no cost. the market will not reward the holder of unsystematic risk at all. So there are some risk premiums that the market offers to people that are associated with risk investments. But if that risk is unsystematic and is a risk that can be diversified and it can be scrapped off, that risk is not going to receive any premium. It is not going to be rewarded at all. Systematic risk cannot be diversified away without cost. Investors need to be compensated by a certain risk premium for bearing systematic risk. So we see that unsystematic risk, the market is not going to reward you for bearing unsystematic risk. Because unsystematic risk, these are risks that can be diversified away. And if you bear such a risk, the market is not going to reward you for you bearing that risk. But for a systematic risk is a risk that cannot be diversified away without a cost. Hence, for that reason, the market is going to reward you with a risk premium for bearing that systematic risk. Diversification and the beta. So the beta measures the systematic risk. Investors differ in the extent to which they will take risk. So they choose securities with different betas, e.g. an aggressive investor could choose a portfolio with a beta of 2, e.g. a conservative investor could choose a portfolio with a beta of 0.5. So we see that these are betas which are representing the size of the risk. And for somebody who is a risk lover is going to enjoy those betas with higher magnitude compared to that one who's conserving. So a measure of sensitivity of a measure of the sensitivity of a stock's return to the returns on the market portfolio. So this is the equation for beta. You'll be given the covariance and the variance. The only thing you have to do is get those values and put them in your equation. There's nothing complicated. You don't have to solve this. You'll be given the values, and those values, you just have to put them in the equation. Investors need to be compensated by a certain risk premium for bearing systematic risk. So if you are an investor and you see that your investments are bearing a systematic risk, you'll be compensated. You'll be given a risk premium, you see, which is a reward for you bearing that risk. But for unsystematic risk, I repeat myself, that kind of risk is a risk that can be diversified, and for such a risk, the market is not going to reward you at any point. The reward to risk ratio for any individual security in the market. So here we are looking at the reward, the premium that you'll be given to, the premium that will be given to you for bearing, the premium that will be given to you for bearing a given risk. That is what we are looking at. So the reward to risk ratio for any individual security in the market is equal to the market reward to risk ratio. So this is just an equation that is showing the ratio of the reward to the risk. So this is the reward over the risk. So this will be the premium, the market premium, and the risk associated to your stock. The market reward to risk ratio is effectively the market risk premium, which is defined as this. The market is defined as a portfolio of all wealthy, including stocks. Rearranging the above equation and solving for the expected return. So this is the general formula for general formula for capital asset pricing model. And we saw that this covariance over variance is just the beta. So our equation will be the expected return. The expected return is equals to RF, the returns on stock F, plus beta, the risk, and the market premium. So this is the equation that we are going to be using for capital asset pricing model. And the only thing you will be doing is just getting the figures and putting them in the equation. All the figures will be given to you. You don't have to solve those figures. You just have to solve the equation of the expected return. Security market line. The graphical relationship between expected return and the beta is the security market line. The slope of the security market line is the market price of risk. The slope of the security market line changes periodically as the risk-free rate and the market expected return change. Sample calculation for security market line. So you've got equation of security market line. So this is the equation that we had earlier for capital asset pricing model. So everything has been given to you, as you can see. Everything has been given to you. And the only thing that you have to do is calculating the expected return. Return per unit of systematic risk is 8%. 8%. And the return due to risk-free return is 3%. So we've got the risk-free return, which is 3%. Here, the return, risk-free return is 3%. And you also have the returns. The systematic risk return, which is 8%. And you've got a beta of 1.25. And your beta, when it is 0.6, you have it here. So looking at what was happening here now is you get your beta here of 1.25 here. This 1.25 beta has been given to you. And this is our equation. The expected return on the stock that you have gotten or the investment that you've made. So this first one, which was here, this represents the returns, the free market returns with no risk, the risk-free return, which is here, 3%. It is 0.03. It is 0.03 because we just divided it by 100. We just divided it by 100. And then this 0.8 is representing the whole premium inside here, which was 8%. It's already been accounted for. It's already been accounted for the return, the free return. So the return per unit of systematic risk is 8%. So that 8% we just divide it by 100 also. When we divide it by 100, that 8% you just plug it here. It will represent everything in the bracket. So it becomes 0.8%, or 0.8, sorry, 0.08. So when you multiply this and add it to that, you get 0.13. When you multiply this by 100, you get 13%. So you can express it in absolute terms or percentage terms. So in percentage terms, it's 13%. So the expected return of that asset using the capital asset pricing model calculation, or the SMLE calculation, which is the security market line, you find that you get the answer of 13%. Then if your beta is 6, so the only thing that you have to do is, where there's 1.25 here, where you had put 1.25 on your beta 1, you just put there 0.6. So when you multiply 0.6 and 0.08 and you add it to 0.03, you get 0.078. And when you multiply this by 100, you get 7.8%. Seven point 8%. If you show the security market line with excess returns on the vertical axis, the equation of the security market line is the capital asset pricing model. The intercept is 0. The slope of the line is the beta. The more risk you carry, the greater the expected return. So this is now the equation for the capital asset pricing model, the same one we looked at earlier. So these are what they stand for. You've got the expected return on the security I, which is there. You've got the risk-free rate of interest, which is there. And you've got the beta of the security, which is there. And you've got the expected return on the market, which is this. The capital asset pricing model deals with expectations about the future. Excess returns on a particular stock are directly related to the beta of the stock. The expected excess return, sorry, the laptop is running low and I was checking on the power source if I can connect it. Let me try to connect the power source. Sorry for the interruption. I was trying to connect the power source because the laptop was running low. So we've got the capital asset pricing model deals with expectations about the future. Excess returns on a particular stock are directly related to the beta of the stock, the expected excess return on the market. So we see that when we look at the equation of the capital asset pricing model, all the variables that we have after the equal sign, when we look at our left side, we have got the expected return on the security. All the variables that we have on the left side are directly related to the expected return. And we see that hence the beta of the stock influences it, and the expected excess return on the market will also influence the expected return on the security. The capital asset pricing model assumption. The variance of the return and mean return are all investors care about. So we see that the variance and the mean are what the investors care about. This is because they are going to influence the beta, which is the systematic risk of that security. Hence, The variance and the mean are the things that investors are going to care about, because they are going to show the investor how much a given security is dispersed or is spread from the mean, and hence it's going to show the level of risk through the data. Investors are price takers. They cannot influence the market individually. So we know that different types of markets have got different patterns. In most cases, investors are price takers. They are in a competitive environment where price is already fixed, and they cannot influence the market on an individual level. All investors have equal and costless access to information. There are no taxes or commission costs. So these are the assumptions of the capital asset pricing model. Investors look only one period ahead. Everyone is equally adept in analyzing securities and in interpreting the news. So in as much as you are making investments, you need information. You need to know what's going on. And in doing so, you'll be able to make the right decision about the investments that you want to implement. So these are some notes on the capital asset pricing model assumptions. Several assumptions are unrealistic. So let us look at the assumptions that are unrealistic. People pay taxes and commission. And we saw that the capital asset pricing model was assuming that people do not pay taxes and commissions. Many people look ahead more than one period. So for the capital asset pricing model, it looks at one period ahead. And we see that that assumption is unrealistic, because when you're making decision as an investor, sometimes you're going to look at periods which are even which are more ahead of you, or more periods ahead of you. For example, you were just looking at a period of 1 year which is ahead of you, but you would also want to look at a period of 2, 3, 4 years from the time of an investment. Not all investors forecast the same distribution. And then we saw that for the capital asset pricing model, it assumes that all investors have the same information and they are able to forecast the same decision. But that is an unrealistic assumption as well, because in as much as you are forecasting something or getting information about something, the decisions that you are going to make are not going to be 100% the same decisions that another person trending in that business will make. Theory is useful to the extent that it helps us learn more about the way the world acts. Empirical testing shows that the capital asset pricing model works reasonably well. So we've got determining the expected rate of return. Determining the expected rate of return for a risky asset. So we've got the same equation that we are using. So we've got assume that the risk-free return premium was 6%. And we saw that the free return premium, the free risk interest was 6%, and the free risk interest is supposed to be here, 6%. And this 7% is the beta. So this 7%, which is 0.7, is the beta, or it's 70%, sorry. This 0.7, which was 70%, is the beta, and it's going to be plugged here, and the market premium of 12%, which was 0.12. And from the market premium, we are going to subtract the implied market risk premium, which was 6%. So in subtracting, we'll get when we subtract this part, sorry, let me go backwards. Sorry, let me go backwards. So we've got the risk-free interest of 6%. We've got the beta of A, B, C, D, and E. And we also have the market interest of 12%, and we've got the implied market risk premium of 6%. You see? So from the market interest, sorry. So where were we? So from the, for us to get the market premium, we are going to subtract the 12% minus the implied risk premium of the implied risk of 6%, which gave us 0.06. So when we subtract those two, those values are going to be multiplied to the betas. When you multiply that value to the beta, you add it to the risk-free interest. And when you add it to the risk-free interest, at the end of the day, you're going to get your value, which is the expected return on A. Doing the same for all the firms up to E, you will see that these are the expected returns that you'll be getting. These are the expected returns that you'll be getting. For firm A, the expected return on the security, it's going to be 0.102, which is just 10% when you multiply it with 100. For firm B, you're going to get 0.120, which is 12% when you multiply it with 100. Doing the same for everything, you will get the values for the expected return on the securities of firm A, B, C, D, or the stocks for A, B, C, D. So this was price, dividend, and the rate of return estimate. So these were estimated and were given as follows. These values will have to, these were the market prices, dividends, and the rate of returns that were given on the market price. And these ones, we have to compare them with what we've calculated. What happens? For stock A, B, C, D, E, and then we calculated these as our required returns, and the estimated returns were this one. You see? So for the first stock, we calculated it as 10.2%. Comparing it to 10%, we found this as the difference, the estimated return, which gave us a negative 0.2%, 0.2%, which was properly valued. And going on, we saw that for stock B, we got 12.0%, which was here, 12.0%. Comparing it with the estimated return, which was 6.2, we got negative 5.8%, which is overvalued. We saw that this was overvalued. And then for firm C, we got 12.9% to 21. It gave us 8.3%. And this shows us that it was undervalued because the value that we required and comparing it to the estimated value, we see that the estimated value is greater than what we got at the end of the day, and hence it was undervalued. For D, we got 14.4%, which comparing it to 3.3%, this one gave us negative 11.1%, and it showed that it was overvalued because we estimated this, and what we got, or what we required at the end of the day was 14.4%, which was our expectation, and we see that this expectation was overvalued. For this scenario example, again, we got 12% and 6.2%. We're expecting too much than what we estimated, and it gave us negative 5.8%, and we saw that it was overvalued. We're expecting too much than what was estimated. And for the last one, we saw that we estimated this and we got this as what we were requiring, but when we do the subtraction, we saw that the difference was undervalued. This is because what we estimated, we got lower than what we estimated. Arbitrage pricing theory, APT background. The APT model, comparison of the capital asset pricing and the arbitrage price theory. Arbitrage pricing theory was developed by Stephen Ross, 1976. His theory begins with an analysis of how investors construct efficient portfolios and offers a new approach for explaining the asset prices, and states that the return on any risk asset is a linear combination of various macroeconomic factors that are not explained by this capital asset pricing model theory. Arbitrage pricing theory, APT. Arbitrage arises if an investor can construct a zero investment portfolio with a sure profit. So we saw that in as much as you are making a portfolio, the portfolio helps to lower the risk. Zero investment. Since no net investment outlay is required, and arbitrageurs can create arbitrarily large positions to secure large levels of profit. Efficient markets. With efficient markets, profitable arbitrage opportunities will quickly disappear. Similar to the capital asset pricing model, it assumes that investors are fully diversified and the systematic risk is an influencing factor in the long run. So just like the capital asset pricing model, the arbitrage pricing theory also agrees to say that the systematic risk is the problem. And the unsystematic risk is something that you can diversify and get rid of. And in the market setup, you are not going to be rewarded for unsystematic risk. However, unlike capital asset pricing model, arbitrage pricing theory specifies a simple linear relationship between asset returns and the associated factors, because each share or portfolio may have a different set of risk factors and a different degree of sensitivity to each of them. Not all analysts are concerned with the same set of economic information. A single market measure such as the beta does not capture all the information relevant to the price of a stock. So we see that it disagrees to say that beta can capture everything, all risks that are associated to a stock, and it cannot generalize the same risks for all the stock. So it assumes that different stocks are associated with different risks. Capital asset pricing is criticized because of the difficulties in selecting a proxy for the market portfolio as a benchmark. An alternative pricing theory with fewer assumptions was developed, arbitrage pricing theory. So this is the theory that was developed as an alternative to the capital asset pricing model because it has fewer assumptions. Three major assumptions. Capital markets are perfectly competitive. So when markets are highly competitive, investors do not have the ability to change prices. Prices are already known and set. Investors always prefer more wealthy to less wealthy with certainty. Investors always prefer more wealth to less wealth with certainty. So investors prefer returns which are high compared to those returns which are low, but they have certainty. So they prefer something which they are not sure of, but they know it has higher returns. The stochastic process generating asset returns can be expressed as a linear function of a set of k factors or indexes. Arbitrage pricing theory, APT. So this is the equation for the arbitrage pricing theory. So you've got RI, the return on assets I during a specified period. So don't be scared with the equation. This equation is going to be short. This is just a general example of this equation. And then EI is the expected return on for asset I. Reaction on asset I's returns to movements in the common factor. A common factor that influences the returns on all assets, which is this. And then we've got EI, a unique effect on asset I return that by assumption is completely diversifiable in large portfolios and has a mean of 0, number of assets N. So, like I said, so like I said, this equation might look complex to you, but it is going to be in short form as follows. Arbitrage pricing theory. Multiple factors expected to have an impact on all assets: inflation, growth, GNP, major political upheavals, changes in interest, and many more. Construct capital asset pricing insistence that only beta is relevant. So we see that for the capital asset pricing model, it was just looking at the beta, but some of these factors can also influence the stock in the market. But for the capital asset pricing model, it was not looking at this. So we've got an example of how we can use the arbitrage pricing theory to calculate for the expected return on a portfolio or the premium of the portfolio. So we've got, consider the following portfolio. Calculate the risk premium on the portfolio. So for you to calculate the risk premium on a portfolio, so these are the assets that we have in our portfolio. We've got X, Y, and Z. So how are we going to calculate the risk premium on the portfolio? So we see that for us to calculate the risk premium on the portfolio, we just look at the assets that we have. We've got X, Y, and Z. we are going to get the 9%, we multiply it with the weight. And we also get the 6%, we multiply it with the weight. We also get the 0, we multiply it with the weight. But we know that multiplying 0 and 0.2, we do it. When we multiply 0 and 0.2, we still get 0. Hence, it will be shown as follows when calculating the premium of the portfolio. So, calculating the premium, we've got 9% of X multiplied by 0.5, its weight, gave us 4.5. We also have 6% of Y multiplying it with 0.3, it gave us 1.8. When we add, we get 6.3%. The 6.3% is the premium of the portfolio. So that was the risk premium of the portfolio, the 6.3%. Calculate the total portfolio risk if market risk premium is 7.5%. So we've got now the B part, which is talking about calculating the total portfolio risk if the market risk premium is 7.5%. So the only thing we are going to do is that we are going to get the total beta, which is 0.8, 0.84, multiplying it with the risk premium, the market risk premium, which we've been given of 7.5%. When we just multiply that, we'll get 6.3% as our portfolio risk if the market premium is 7.5%. So this was the last unit that we are going to be having in investment management, and we are looking at the capital asset pricing model and its assumptions. And later on, we started looking at the arbitrage pricing theory, and we saw the differences of the two and why the arbitrage pricing theory was developed later on. Hence, in conclusion, in as much as you are making investments, you make sure that you consider the risks and you also consider the returns that are associated to that investment, that you want to venture into. Thank you very much.